show that we have a quorum, and we'd like to resume the PSC hearings. Oh, okay. This afternoon we have Mr. And I'm going to try to pronounce that with my north side tongue, because I know I can't say that. Yeah.
I swear by Almighty God that the evidence I shall give to this Honorable Legislative Assembly shall be the truth, the whole truth, and nothing but the truth.
Thank you, sir.
Thank you.
When you want to speak. Good afternoon, sir. Mr. Jasikira.
Mr. Chairman.
Okay, the first time you answer a question, just say your full name and your position for the records. Okay, this afternoon we have some questions for you based on the SEMA annual report for 2015-16 in relation to the role, function, and authority of the Insurance Supervision Department of SEMA to find out whether there's stuff you can do to assist us in having some, and how much control you can in fact exercise over the insurance industry. In fact, I think we will confine our questioning to you specifically on property insurance this afternoon, because most of our constituents have gotten notices that their property insurance is going to go up 20+%. So we want to know whether that's justified or not. So we have some questions based on the numbers reported in the SEMA annual report 2015-16. Mr. Saunders.
Thank you very much, Mr. Chairman. And you don't mind me calling the witness Rohan. I think it's probably easier for me to pronounce. Thank you very much for coming, and I just want the record to state this committee is we're happy to roll at SEMA, and your team members are playing with regards to our financial industry. I think you guys are doing a good job, and part of that and why we're here is to look at some of the work that you guys have been doing and directly see what we can do to probably benefit the public. The genesis of your arrival today, just to kind of recap, is when we were looking at the 2015-2016 report from SEMA, we noticed that and just to kind of give an idea, which will be on page 30, that the total underwriting income or net income for the health insurance division as per your report for all the different domestic insurance companies was $51.5 million. And why that jumped out to us is that when we look at prior years, in particular 2011, we noticed the profit was $4 million. In 2012, it was $10.8 million. In 2013, it was $14.3 million. And in 2014, it was $14 million. So when we look at 2012 to 2014, the total profit was $43.1 million, averaging $10.8 million. And then we saw it jump up to $51.5 million. So naturally, the health insurance industry, well, the report kind of really jumped on our radar. With regards to property, and naturally while we're looking at the table, we couldn't help but glance over and notice a trend also on the property side. And just to see what the the chairman had mentioned earlier, just to put things in context. When we look at the same report, the SEMA annual report for 2011-2012, page 26, we notice that the profit was in 2011, 27 point roughly 9 million on property. In 2012, it was 27.8 million. In 2013, it's 28.4 million. And then we notice it jumped up to 60.5 million in 2015 and 48.2 million in 2015. So again, just looking at the health insurance on that side, they were pretty much averaging. Sorry, just want to check my notes here. 1 second. Yeah. Sorry, yeah. So they're also well above the average in which they were operating on. So what we wanted to understand, and then considering now the amount of notices that people have been getting concerning property insurance going up, we're trying to wonder what is it that the authority can do, or if there's anything, other than outside the supervision role in terms of protecting the consumer to some extent against what is happening here. And so that would be pretty much the first question. But at this point, especially on the health side, where we see where the private health insurance is cherry picking, a lot of stuff is being dumped in Cynical, which is covered by the taxpayers. And now we see on the property side where they're already making these kind of numbers, and now they're giving people are getting notices that their property insurance is going up. And again, we're already seeing where they're making an IF the profit.
Mr. Chairman, Honorable Committee, my name is Rohan Jayasekara, Head of Insurance, Cayman Islands Monetary Authority. Through Mr. Chairman, I would like to first of all respond to the property market. And the reference was made to SEMA's annual report, where we record the numbers for the year 2015. That's the total when it comes to property. There are about 12 property insurers operating in the Cayman Islands as of now, actively. And if you look at it a bit more detail, we can categorize these into 3 buckets. First of all, there are companies that are locally incorporated. There's a balance sheet in the Cayman Islands, and there are the other companies, agencies or branches of foreign companies. Now, these companies are regional carriers, small to medium, or could be very large international carriers. So their capacity to accept premiums, accept risks, and retain risks varies hugely. Now, in the insurance world, when a company writes premium, when they receive premium, if it's a smaller company, they keep very little and they reinsure or insure with a larger carrier. So, for example, if they collect $100 as premium, they keep about $10 and they reinsure $90. So if there's a claim, for example, for $50, they apply the same percentage. So they are paying $5, the local company, and they get $45 from the reinsurer. So this retention varies significantly depending on how big you are, how capitally strong you are. So that's very key. If you look at these numbers in more detail, it's not available on our annual report, but I have access to the licensee. There's one particular licensee which is huge in our context internationally, and that company can, or they do, retain 100% of what they write. So that company actually distorts our industry figures if you take it collectively. And so if you look at the companies that are locally incorporated here, it's a different story in terms of the numbers. Now, if you look at the rates, I have the numbers, the overall, what the industry wrote for property since 2013. In 2013, it was 115 million and dropped to 106 million in 2014 and dropped to 91.9 million in 2015, dropped to 80 million in 2016, dropped to 73.6 million in 2017. As we know, this is property. That's their way where they insure houses and other properties. And as we know, the number of houses, properties are increasing. Yet the total premiums have declined over the years. So that tells that the rates have actually come down. Now, I personally don't own a property here, but I have spoken to few people. But what they have seen is over the last few years, the premium rates have significantly come down. And I think if I look at this top line, that's what it says, because we have not seen our risk or number of houses shrinking. It's actually growing. Still, the top line has come down.
Thank you very much. Quick question, just looking at the report. What is the difference between the direct premiums and assumed premiums?
Through Mr. Chairman. So direct premium is the companies that are selling properties to the residents and businesses. We go walk into an insurance company and pay a premium, and that's accounted as direct premium. There's one or two, predominantly one carrier here licensed by us as a Class A company, and they reinsure. That's the company that I referred to as the part of a large international group. So in addition to them selling directly to the residents, they reinsure other companies based in the Cayman Islands. So they insure insurance companies. So premium assumed is the premium earned like that.
Quick question, when did this dominant company, I guess, started doing business in the Cayman Islands?
Mr. Chairman, I cannot exactly remember the license date, but they have been here for many years.
Thank you very much. The reason why that jumps out, and the reason why I asked that question, is that when we look, going back again over the last 5 years, one of the things that we are concerned with is that when I look at the revenue, so for example, you take 2011, the direct premium was 114.6 million, and then the reinsurance ceded was 88.1 million. So the relationship there was roughly 77% between those gross written premiums and the reinsurance ceded. So that's 77% there. When you move to 2012 and you look at the direct premiums versus the reinsurance ceded, we end up with $85.8 million. And when we look at direct premium of 113.5 million and then the reinsurance ceded of 85.8 million, we had a relationship of roughly 75.5%. Now, when we move to 2013, we notice the direct premiums versus the ceded premiums of 150 million direct premiums versus 79.6 million in ceded premiums, we end up with a ratio of 69%. So up till then, for those 3 years, the profit from those in the property division was roughly 27.9 million, 27.8 million, and 28.4 million. So those 3 years look pretty standard. When we move now to 2014, we notice, yes, you're correct, that the direct premiums dropped, but then assumed premium, which is now the reinsurance kicking in. So the direct premium dropped to 106.2 million, but the assumed premiums went up to 30.1 million, and then the ceded premium was 75.4 million, creating a relationship between the revenues, the direct and the assumed, versus the ceded of 55%. And then and of course, those are the 2 years. That was the first year they had a 60.5 million profit. And then in the second year, the direct premiums again decreased, but again, the assumed premiums, when you look at those compared to the ceded premiums, the relationship is 57%. Let me tell you exactly where I'm getting to, Ron, in all of this. 13 years ago, we had a massive hurricane in this country. And what we found out the hard way was people thought they had insurance, including the government. And they basically realized it wasn't worth the paper it was written on. We had the dial fiasco, where those guys were basically out there taking a very low reinsurance, assume more risk, and as a result, the consumers of this country got shortchanged. We had Cayman General Insurance doing exactly the same thing, that the government had to bail them out, so it wouldn't end up having a devastating effect on the economy. And with an active hurricane season expected this year, and knocking on wood that we have gone 13 years thus far without a major insurance, the question for us, the question for this committee is, what comfort level can the public have that these companies that are assuming more risk directly, and we have seen what has happened in the past when they did that and they couldn't pay up. The question is then, what comfort, one, does the public, or can the public take in ensuring that this won't happen again? And then two, what is SEMA doing to ensure it doesn't happen again? Because I can guarantee you it's going to be a complete different time this time around. Thank you.
Mr. Chairman, good question. Actually, again, going to numbers for a moment, the ceded premium is the premium that you receive in my example earlier. If you sell $100, you reinsure $80. So 80 is the ceded premium, 100 is the direct premium. Now, if I go into details of these numbers that is not visible on the annual report, if you leave that large international carrier, all the other companies are keeping about 10%. All the 90% is reinsured with extremely large international carriers. They are A-rated by most of the financial rating agencies. That's how insurance works. This is all cross-border. Now, so that continues. That has been the case. Our companies are not large enough to go beyond that because you need huge capital to support whatever the risk that you retain. So it's typical that they reinsure with much larger reinsurance companies. Now, these reinsurance transactions, as far as SEMA is concerned, there are international standards that regulators need to follow or are required to follow or asked to follow when assessing these transactions. We need to look at how strong these reinsurers, international reinsurers are, their capacity to pay, how liquid they are, and the terms and conditions clauses used in the reinsurance contracts, and the expertise that they provide to our local companies here. Now, we do a couple of checks on our companies regularly. Our Class A companies are required to file their financial statements every quarter. So every quarter we know where they stand in terms of their financial position. They are required to maintain certain capital, that's shareholder equity positions, based on the lines of business and the volumes. And if we see, obviously we see issues, we raise them with them. We meet with the top executives of these insurance companies. In preparation for the hurricane season, it's normally we look at the reinsurance programs of these companies. Actually, this year, again, there's a meeting going on right now with one of the carriers. So we have asked them a set of questions, not only the financial side, but how prepared are you to face operationally? For example, if something were to happen, the employees, the staff of insurance companies gets affected as well. So how much resource do you have now to deal with the policyholders? So these are the type of questions that we ask. And we look at in great detail the technicalities of the reinsurance companies and their transactions to make sure that they are structured in a very clear way. So if there's an event happens, we know which reinsurance policy kicks in to pay and where they are going to get funds. There are certain technicalities, for example, the reinsurance define single event. For example, if a hurricane hits our neighboring territory and within 72 hours it hits Cayman, it is kind of considered one event. So how prepared is Cayman as well as the neighboring jurisdiction to face two events under one reinsurance contract? So there are possible scenarios, and these companies use what they call catastrophe models to model and run various scenarios. Okay, first hurricane, within the next 2 weeks another hurricane, and how catastrophic it could be, whether it's a category 5 hurricane, category 2 hurricanes. So there's a lot of modeling taking place, and then we don't really go into details because it's more engineering and mathematical, but the board need to explain to us their rationale for arranging these reinsurers and how much capital they are holding. So from CIMA's side, I think I can assure you, this honorable committee, that we are doing everything we can to ensure that our companies remain financially strong and operationally ready to face anything. And at the same time, we are thinking of doing an educational, some form of press release to the public, because this is they have a responsibility as well. First of all, they need to make sure that their policies are enforced. And what is most important is just to make sure that they have insured their properties at the right amount. Unless your property values, say for example, 300,000, you need to insure it for 300,000. If you have borrowed through financing 200,000, you shouldn't insure that for 200,000, because if there's a claim, you only get 200,000, not the 300,000. Or if it is not a total loss, it's a partial loss, the insurance company would apply kind of a percentage. So these are extremely important as policyholders to be aware and talk to the insurance companies. I know we hardly read these contract documents, policy documents, but it's critically important that you try to read and understand, or tell your broker to explain that to you, especially clauses, conditions, and say, what are the areas that are not covered, so that I know what is covered and what is not covered. If it is not covered, that I need to take action. So we are looking at both these aspects just to make sure that as a jurisdiction, as a country, we are ready for any event.
Thank you very much. Going back to the one large company, which is, as you say, an outlier, I'd be curious to know, and I know you probably want this information now, and one of the things that this committee would like to get is, we don't need the names of the companies, but the breakdown in terms of the 8 or 9 companies that actually make them, so we can directly see what is what. Because one of the things, looking at the numbers, if we have one large person that's coming in now and basically doing, in essence, reinsurance themselves, it means that they're also, in essence, can have a competitive advantage against those that are selling, because in other words, they're keeping for themselves. So from that standpoint, then, is it a situation where this one dominant company now is going much closer on the margins, being a reinsurer, where it's putting pressure on the remaining companies to raise their premiums? Because at the end of the day, reinsurance is still reinsurance to some extent, but like I said, what triggered this is that many people have received notices that the insurance is going up. Now, in the last 13 years, we have had hurricanes within the Caribbean, yes, but we have not seen any increases or major increases in the premiums to the level that we are seeing now. And so we're trying to figure out what is triggering now this. So is it a reinsurance issue, or is it a situation that one dominant company now is eating the food of the other companies and they're now looking to recover?
Mr. Chairman, I think 12 companies for a population of 60,000 is significant. We have recently done, about a year ago, we have looked at comparable jurisdictions and larger countries. The ratio is way more than us. So we have 12 companies and competing for the same business. I think that to an extent, driven the rates down because they're all trying to obviously win the same business. However, this particular insurer, it's not really competing for the retail business. They are so big, and there are certain risks, properties that could only be written by large insurance companies. They have the expertise, they have the capital to support it. So I don't think that this particular company is influencing the rates. Now, as I mentioned, I think if you look at the numbers, the rates were coming down. Whether policyholders have been told to prepare to the rates go up, it is not because of this particular insurance company, but I think it's mostly, if it is going to happen, it's something to do with the hurricanes, the losses that the Caribbean had in 2017. Now, how is that going to affect us? Is because, again, we are small. So when you reinsure, some companies or reinsurers cannot treat Cayman alone as a standalone geographical area. So what they do is they pool it. They pool us with maybe the territories in the Eastern Caribbean and some other Caribbean countries, because we are geographically small. In terms of number of risks, we are very small. So when you combine, and even though there's a good year for us, if it's a bad year for someone else, unfortunately we have to be part of it. That's unfortunately how it works, because we don't have the numbers. And also the rates, if you look at the Class A companies, the 12 that I mentioned, 11 of them actually specialize in, one is specializing in motor, but they do a little bit of, but they are reinsured with the same panel of reinsurers. So the reinsurers not only, as you know, insure Cayman properties, they reinsure risks in Japan, they reinsure risks in the US, somewhere else. So when something hits some other part of the world, it hits these reinsurers' balance sheet, and they have a bad year, and they try to make the next year a good year by raising their rates up, and that could affect us. So they're all interconnected, because our size and our risk pool, it is very difficult, unfortunately, just because we had a good year, nothing affected us, that to expect, or next year is also going to be a good year. But I'm pretty sure the competition is still driving these rates down because they want to win business.
Well, actually going up. The thing about it is, and Ron, forgive me because I am still also a politician, and I'm trying to say to my constituents and to the general public that in excess of over $100 million a year in premiums for the past 13 years thereabouts, on average, you would have collected $1.3 billion in premiums from the domestic market since Hurricane Ivan, but you have not paid out anything. And then all of a sudden now, so you already made over $1 billion from the Cayman market. And you, BVI or Anguilla and Turks, got hit, and we're saying to the people, even though you have made over $1 billion from us since Hurricane Ivan, $1 billion with a B, we now have to come and charge you more now because those guys got hit. Is that what it is that we're being told that we need to go and tell the general public?
Chairman, it's a fair question. That's one way of looking at it, and yes, non-technical person would look at it. I have been keep paying, I didn't have any claims, and why am I now required to pay more? But again, as I said, it's all interconnected. When reinsurer is connected, that's how technically it works. But, sorry.
No, agreed. Now, these same companies that sell insurance or the reinsurance also do motor, correct? Yeah, so some of the insurance do the motor coverage.
Sorry.
The reinsurance companies, like the motor on the cars. they're
Yes,
also
They do reinsure as well, yes.
Yeah. So then the question is, why do we have no claims discount on the motor side, but we have no claims discount on the property side, if it's still the same reinsurance company?
Motor is more prone to claims, and you expect the drivers to be careful. So no claim bonus is actually a encouragement to be safe, because if you are extra safe, not only that you are safe physically and you make the public safe, but also you save something. Now, my house, if I have a house, if there's a hurricane, I don't have a control over the hurricane. I don't have a control over my burst pipe. I do have some control, I maintain it, but it is not as closer to a motor vehicle that I'm driving, that I'm on wheels. I have a direct control to the risk it gives the insurance company. So that's why they encourage people to drive safe, so they get a no-claim bonus. Now, property, sometimes they offer, but it's not as common as in the motor insurance, but they get compensated positively by rate reduction. So I believe over the last few years, the rates have really come down. But the international market, what they say is the reinsurers, there's a lot of capital, because there are good years for reinsurers, there are extremely bad years for reinsurers. Yes, we had some events in the US, especially the floods and hurricanes impacting closer to us. So that is influenced to an extent, but still there's a lot of capacity, a lot of money out there in the reinsurers. The investors are willing to insure in these large international reinsurers. So I hear both sides saying, okay, be prepared, the premiums to go up. But on the other hand, I'm also hearing people say that there's a lot of capacity and a lot of money out there for reinsurers, so that they don't expect the reinsurance rates to go up a lot. So we have to wait and see actually when the insurance company comes and say, okay, this is how much your premium is going to increase. I think if I were a policyholder, I would shop around. I go to the broker and say, give me some other quotes, and make a best choice. But again, as a regulator, I would say that don't always be driven by the premium, because it's not easy to compare one policy versus other policy, because it could be on just dollar terms, because maybe policy 1 offers you some coverage that the policy B doesn't offer you. So this all needs to be. So what I was saying is that I don't think the premiums rates are going to be like increased like about 25%. But the problem as far as the authority is concerned is that we have a control over how the conduct of these insurance companies, but we don't have a mandate, because it's not a tariff-driven market. As you know, we don't control the rates, we don't control the premium. So it's not possible for us to say, if company A decides, okay, for whatever reason, we are going to increase the rates from 100 to 125, it is not possible for us at the moment to go and say, no, 125 is too much, bring it down to 110. We can ask questions, but I'm sure, because again, because of the competition, I don't think just one company could significantly increase that much, because they'll run out of business.
Well, going back to your earlier statement where you said that I think we have 12 insurers for this market, then it means there's a certain amount of fixed costs, and basically everyone needs to capture it. So it's almost sounding as if though the rates are going up simply because there's just too much. People are just basically getting squeezed out, and they need to squeeze more out of the customers because competition is that stiff. Having 12 insurers, shouldn't it be going the other way, where eventually somebody should fold up and get out of the business, as opposed to where we are? Because competition normally is supposed to be carrying the rates down, but in this case, they're carrying the rates up.
If I may, Mr. Chairman, I think if insurance companies or company decides to increase the rates now for 2018 as a result of, it's directly linked to the losses that they incurred in 2017 in the region. Over the last, I have details since 2013, as I presented, the rates have been coming down. So yes, we all enjoyed rates going down, but now because we were blessed, the region was blessed with no events. Unfortunately, there were a few events. Now there has to be a correction. And how much that is going to be corrected, it's yet to be seen. Competition plays a huge role. Now, as a regulator, sometimes it makes us nervous when there's too much competition because it reduces the number of policyholders per insurance company. Now, insurance is based on what we call probabilities, law of large numbers. For insurance to work properly, you need more people, more risks. So if the 12 becomes 15, 20, good for consumers in a way, probably it will further bring the rates down, but on the other hand, we have to be extremely careful that because the size is shrinking, that these companies really have the assets to support the operation here, so that when there's claims that they are financially able and in a position to support. But I think nothing changes. Still, the competition is a factor, and I hear it from our licensees that they say rates were coming down. Obviously, as a business organization, they weren't very happy because when the rates are up, their direct premium is up, and the premium that they see to reinsurance goes up, and they get a commission from the reinsurance companies for that. So their commission goes up, so their bottom line increases. But it was going the other way the last few years. But what's going to happen is a kind of a correction, but that correction is 15%, 10%, 5%, 25%. It's not easy to say at this stage.
Okay, that's, well, pretty much my last question along this line. As a regulator, how comfortable are you that what happened after Hurricane Ivan, where a lot of consumers got burnt, where they thought they had insurance and basically got gypped, that we are in a much better position now, and that we have learned those lessons from Ivan, that the people who are selling insurance in this country, especially property insurance, the people who are buying insurance, especially property insurance, are actually covered, and we won't find a situation where the checks start to bounce or companies getting folded up or anything like that. So, just for the public reassurances.
I can assure you to the Honorable Commission that we are in a much, much better position today than in 2004. I was personally not here, but I have heard what happened in the market and how difficult it was for some of the companies that went out of business. Many things have happened since then. Laws have been changed to make sure that these companies are financially more secure and assets reside in the Cayman Islands. I mentioned that there are certain companies that are branches of foreign companies. They don't have a balance sheet here because they are not legally incorporated, but they're registered. However, such companies are required to hold assets in a trust in the Cayman Islands, in a Cayman Islands bank. And if you remember, during, I think it was 2007 and 8 time, we had some failures, and those trust asset arrangement came into play, and I think it was tried and tested. To date, there are policyholders who have not yet got paid as a result of failures of these companies, not in Cayman, but other parts of the Caribbean. But our policyholders were mostly saved because of the trust arrangements. However, we learned some lessons from that, and then we changed laws, so now there's a greater buffer now than what we had in 2007 and 2008. And CIMA's expertise and staffing, of course, the resources have increased. We have in our staff reinsurance specialists who are specialized in that area, who can read a reinsurance contract and understand areas that are of concern. So these are huge developments, and I as head of insurance, quite comfortable, not just as a resident, but as a regulator, that we are much prepared now.
So you don't have a threshold that you have established in the regulatory framework that you require these property insurances to have reinsurance for as a percentage of their portfolio?
Mr. Chairman, we don't have a ratio at the moment.
Why not?
I think one thing is difficult, given the size of our companies, for us to force a ratio as such. And what we do though is we look at how much they retain and how much capital that they are having, because it's every company's wish to retain more, because the more they retain, the more profits they earn, and the more profits they retain. But when the companies start their business as startups, it's typical that they reinsure 95%, and with the positive experiences, they reduce the numbers. So it is not something I believe externally we can force on them. However, what we have is guidelines that if you are reinsuring, these are the qualitative guidelines that you need to follow and justify to the authority that your whole reinsurance rationale.
Sorry. You guys force certain thresholds on banks. Why the insurance companies any different? I mean, risk management is still risk management, and ultimately, the main genesis behind SEMA's existence is to protect the public or to protect the public's money, not the other way around. So, if SEMA believes that a certain best practice is protecting the consumer, then naturally it should be able to do that. And just to put it in context for the listening public, if you decided you want to go into the lending business, you would need SEMA's, you would need to be regulated by SEMA because you're lending your money. The minute you're taking money from the public, then this is where SEMA regulation comes in, because now you're taking something from the public. So, so this in essence is no different than the same thresholds that you put on a bank for managing risk. I don't see why within the insurance industry you can't nudge them to make sure best practices, because I'm going to tell you right now, I would prefer to know that there's a 90-95% reinsurance as opposed to what we happened with one company where the government had the bailout, where they were doing like around 70% reinsurance, assuming 30% of the risk, and then couldn't pay up when the time come. You know what I mean? So from that standpoint, it's kind of really scary when regulators who are supposed to be looking out for the public are saying that they don't want to do something when in fact that's what you're supposed to be doing. You do it for the banks.
So, Mr. Chairman, we do look at their capital. So we look at the whole thing together. What I said we cannot force a company to do is and say, no, you have to maintain 20% of your direct premium. It is not possible for us to force that without them adequately capitalized. So that's why it's the capital that they hold to the retention is very correlated. So if I want to start an insurance company tomorrow, I find 10 million as capital, and there's a limit that I can retain, and everything else I need to reinsure. The reinsurers will look at your capital and they will determine, no, you cannot hold more than this percentage. If a company that has been in business for 25 years with 50 million capital can hold more. So that's why it's difficult for the regulator in a jurisdiction like ours, where the base is so small, to enforce a company to keep a percentage. But yes, there are other larger jurisdictions that have minimum limits. However, what we do is, of course, at the end of the day, we have to make sure that our insurance companies are able to honor their claims when there are claims, and they could honor them quickly. So it's not only the solvency, it's the liquidity, how liquid your your balance sheet is. So why we look at it is that if you decide, your board decides, okay, this is my risk appetite. Now, again, it varies from board to board. Certain boards think, oh, we need to be extra conservative, and therefore they purposely keep a small retention and they reinsure a lot. So the risk appetite varies as well. What we as regulators are looking at is, okay, justify your reinsurance arrangement, and then we look at the capital depending on various scenarios. If scenario 1 happens, is your capital enough to pay your claims? If scenario 2 happens, is enough? So that we do just to make sure that all possible scenarios are covered, that the company is able to pay when there are events, when event takes place.
Sorry. Earlier you said that some of the lessons learned is that you require the companies to keep more assets here, correct? No, yeah.
Correct.
When you say the assets that they're keeping here, is it the capital assets that you're referring to? Because the reason being, the majority of the companies, in essence, are going into the overseas market and buying the reinsurance. And are we to assume that the reinsurance have their money here? Or is it a situation where that reinsurance money is overseas? In essence, the question is, what percentage of the coverage is actually here in the Cayman Islands in terms of those assets?
Chairman, the assets are what we call it the most secure liquid assets. These are the deposits in the banks or letters of credit where you can easily convert them to cash. So what the law requires them to hold is net of reinsurance. Now that's why the reinsurers play a critical role, that their liquidity position. That's why we look at the reinsurers' strengths and their ratings and the regulation, whether these are coming from highly regulated jurisdictions, and most of the larger companies are coming from the US, Switzerland, Germany, Ireland, England, places like that, highly regulated. It is not possible, again, for a smaller jurisdiction. When I say small, I'm always talking about the number of risks from that perspective, to demand these reinsurers to hold money, and they don't keep different pots of money everywhere, because what they also do is they obtain what they call retrocession. So they also reinsure with larger companies, so that the money goes around so that one event won't have an impact on one economy. That's how the cross-border insurance works. So they don't really keep assets in a company, a jurisdiction to say, okay, if something were to happen, here's my money. But insurance companies that we regulate are required to hold that money in the Cayman Islands. Now, these are for the branches of foreign companies. The locally incorporated companies have a balance sheet, so which means those assets are legally in the Cayman Islands, or it's Cayman Island, they belong to Cayman Islands.
Okay, thanks very much. In terms of looking at the reinsurers, who in SEMA would be the person, well, I guess outside, you say you had someone on your team that specialized in reinsurance. Where's the person that would have found the AIG? Because AIG was one of those big, massive reinsurers that also still got burnt. And I guess everyone automatically assumed that these reinsurers were invincible until the financial crisis. So then the question is then, are you guys comfortable now that within the reinsurers that our companies are dealing with, there is not one of those AIG-like companies lurking around to make sure we got that basically that the consumers get burned? And you guys are also looking at those guys.
Mr. Chairman, yes, we do. Now, there is a rating agency specifically rate reinsurance companies. They're called AM Best rated companies. Now, we look at those. Yes. Well, yeah, the AIG showed us this, and some other failures showed us that having a good rating doesn't necessarily mean that the companies cannot fail. What I hear is that, or what I've heard is that it's not just insurance was the cause or the only cause for AIG to fail. AIG was not only insurance; it had some other operations and other businesses. Yes. So we we look at these companies for their balance sheets, their ratings, and what jurisdictions. Now, for example, the carriers coming from Europe follow Solvency II regulatory framework, a much more robust regulatory framework where there's tons of reporting requirements and capital requirements. And the US carriers, of course, that's one of the largest insurance, reinsurance domiciles. It's much more sophisticated frameworks. So if we see some reinsurer coming from never heard jurisdiction, we ask questions. And I can assure you that most of the reinsurers, I say pretty much everything, are extremely highly rated. And where there's no, what I say highly rated, A plus or A minus, these are the highest ratings, coming from a jurisdiction that are known, that are not known for its their reinsurance business and not carrying a very high rate. We ask questions, we look at the balance sheets, and sometimes we have regulator to regulator contact and ask, is this company in good standing? Did they have any problems? Who are behind these companies, the individuals? Because most companies fail not because of their technical issues. Sometimes it's because of corporate governance issues. They are not run by the right way by the right people. So we look at the people behind these companies who are making decisions. So there's a lot of reviews and analysis going into these reinsurance companies and the program. So that gives us a lot of comfort.
If we look at 2015-16, right, we will see that on a total underwriting income locally of 53 million, which includes the reinsurance being taken out of the direct premiums, right? They would have paid out their reinsurance premiums out of the 91 million plus the assumed premiums.
That's right, Mr. Chairman.
Okay, but so they're out of $53 million in retained locally, out of that 91 million, they only had claims of 5 million to give them a profit of 48 million. And you're suggesting that in that kind of a scenario, an increase of premiums in the local market can be justified because of something happening in some other jurisdiction?
Mr. Chairman, if you really, that's the 12 companies together. But if you look at local companies and international companies, it's slightly different. So it's, as I said, I think there's one or two companies distorting these whole numbers.
But they're not distorting anything. So the figures, are you suggesting that the figures are being so distorted that they can't be trusted?
No, this is the, Chairman, this is accurate numbers, okay. But this is for the whole industry.
Right.
So within that,
but it is not the information that we have, it is not only the local companies or one company that is proposing to increase premiums. It is that it appears to be an across the board, because I have insurance through a broker, right? And although the insurance company that they had me property insured with last year said were going to do a 27% increase this year, right? I said, I ain't paying that. So they went out into the marketplace, and the best they could get for me was a company that was only doing, I think it was 25-point-something%. So this is not a situation where there's only a couple of companies are doing increases. It appears that everybody is going up with this increase. And even if 40 of the 48 million in profit went to the international companies, one would have to assume that in that situation, at least 45 out of the 53 million in premiums also went to because the big companies are not only, they're collecting the majority of the premiums, and if they're making the majority of the claims. I mean, I would assume that if you're collecting the majority, if you have the majority of the customers, it is unlikely that you're not also getting the majority of the claims. Or are you suggesting that averages don't apply here, and that what we need to see is the breakdown on each of the 12 companies? How much premiums they collected, how much they laid off on the reinsurance, right? And how much claims they had. And what each individual profit was.
Mr. Chairman, I can provide some information again on the property side. For example, in 2015, yes, they made a total underwriting income of 48 million. And in 2016, they made 21 million. That's more than half. Just dropped by 50% or more, less more. And in 2017, they made a loss of 30 million. So that explains how volatile the property market is, how 2017. 2017, last year. Yes. Well, it's again, it's because of the reinsurance portion. It's not because it's there's a carrier, there's reinsurance. So there are companies that the policyholder is Cayman, but they have their assets elsewhere as well. So if you leave one or two of those companies, the local companies made a profit of 4 million in 2017. They made a profit of 6.3 million in 2016. So that's why I said it is very different to certain segments to the others. And the losses of 30 million is as a result of reinsurance risks.
But this all comes across to me as smoke and mirrors, man.
Sorry. Hold on. The thing about it is, Mr. Chairman, true, I'm reading something here from the Sun Sentinel in Florida, which was December 7, 2017. And it says, I'm just going to read it briefly. Call it a 1-2 gut punch for South Florida homeowners. The state's largest property insurer, Universal Property and Casualty, has received approval from Florida insurance regulators to increase its rates an average 9.9% for a majority of the company's single-family homeowners in Broward, Palm Beach, and Miami-Dade counties. What really jumped out to me when I came across that article at first is in those countries, it appears that the insurance companies had to get approval from the regulators to raise the rates. Then the question I have to ask here is if this is quote-unquote industrial standard, why isn't it something like that we're also using here, where everyone is getting up and getting some of these 20-30% increases? Now, bearing in mind, those areas got hit. It's 120,000 homes you're looking at for that one company. And they were allowed a 9.9% increase average, thereabouts. But we have homeowners here who have not been hit and are getting premiums as high as a 30% increase. And there's no one there to say to someone, wait a minute, you can't do this. But in other countries, they have to get permission from regulators. So the question then, which maybe this is something that should be more directed to the board, is from where the regulator's standpoint, from a regulator standpoint, what is it that we need to do, or what changes do we need to make in the law to get CEMA on the same level as the other insurance regulators in these countries where they have to approve these increases? But it can't be a situation where families just go to the mail, get one that says, oh, your insurance is going up. And then when you start bringing the conflicts, where some of these banks are insisting that people have house insurance, and then some of these same banks are the ones that are owning these insurance companies. Whereas if you don't even get it, they just take it out and pop it off in you, to use a kind of local term. The question is, at what point are we going to put some teeth in SEMA's regulation? Because ultimately, as I said before, SEMA was born in protecting the public's interests. And to have SEMA there with no teeth, where then does the protection for the consumer comes from? And that is ultimately no. This is, again, like I said, I recognize within the hierarchy there's a senior management, there's a management committee, there's a board and everything else, and I don't want to put you on the spot. But in your humble opinion, what do you think would be the ideal scenario in which you believe, as a person who's a regulator, that you think that we would have to, changes that you think we should be making, or things that we should be doing that you think can better protect the consumer from getting those letters? Because I can tell you one thing, when you got heart problems and you get those letters, it's not nice either. Thanks.
So, Mr. Chairman, it is, well, at the moment, as I mentioned, we do not have direct powers to tell a company not to increase the rates, or you cannot increase more than 10% or 20%. That is something that I guess the country, the SEMA and the industry needs to sit and understand the technicalities behind it. Now, it is difficult for us to directly compare us versus a state like Florida, where there's number of risks. I'm not suggesting that it cannot work. What I'm saying is, at the moment, SEMA doesn't have powers to do that. Whether SEMA should be given powers to do that, that's, of course, as I mentioned, it's a discussion that.
No, I'm asking for your personal opinion from industry standards. If you don't want to get in trouble, I can understand that. But what are you, for you, that you would think that would make SEMA more effective, or would make your job more effective? Because, like I said, looking back at the numbers on even on the medical side, for 4 years, you're averaging 10.4, 10.8 million in profit. Then it jumps up to 51.5 million, you know. Then you see the same thing happening on the property side too. You know, over $1 billion paid in premiums, nothing, no major thing, and then all of a sudden now you're popping it off in some people to the level of 30%. But the people who get hit are actually paying 9.9%, and we're paying 30%, and we didn't get hit. I mean, at some point, we have to say to ourselves, so something don't smell right. And that's what I'm trying to find out is, what do you think would be the ideal situation? Or what do you think we need to do? Because ultimately this is something for the legislator itself, why we're here, that we need to do to give SEMA the teeth to protect the consumers.
So, Mr. Chairman, again, my personal view, it has to be, yes, we cannot let companies come tomorrow and get together and say, oh, your rates are increased by 100%. And we have the option of not obtaining insurance is not an option, actually. So we have to buy. So that's one extreme. We cannot let that happen. But at the same time, it is difficult for us to say charge 0.15% of your sum insured as the rate, and that's it. Because that could drive away some of the insurance companies. They might find it not economical, or it doesn't make business sense for them to operate anymore. That could have any negative impact on the industry. So we have to have a middle ground so that if the increase is significant, they have to come and talk to at least the regulators first and justify why they are doing it. It's not that they are want to declare more bonus next year that they are doing it. They are doing it for real technical reasons and justify, okay, we had this number of losses and that's the reason why. So that's something middle ground, I think. Whether what needs to be changed in the laws and regulations, it's hard for me to say right now. But that's, personally, I think that's kind of middle ground.
The greatest of respect, sir. We're trying to, you're the expert, not us. We're trying to find out what we can do to offer greater protection, particularly we had the health insurance in this morning and now we have the property. What can be done and what recommendation we can make to the Legislative Assembly and what Mr. Saunders was suggesting that in certain jurisdictions, they have to get your approval. We're not saying that you should be in a position to set a hard and fast rule, but certainly we believe that the country needs to move towards some kind, giving you, the regulator, some authority to be able to negotiate and have that they have to justify it to you before they can do it instead of just being done arbitrarily. And in your opinion, would that require amendments to the insurance law? Or can this is something that can be done under the regulation of the law?
Mr. Chairman, it is well, the way it works in Cayman, as you may know, we have the insurance law supported by various regulations, and then we have the third layer, the rules, statements of guidance. I'm not a legal expert, so I don't know the change needs to be done at the highest level or a middle level or regulation level, but it's possible. Whether it needs to be, the rule needs to be fixed or the regulation needs to be fixed is something that we need to figure out the way they are drafted. But I think more powers for us to ask that question on the premium side, yes. If you decide to have it, yeah.
Don't you see it as part of your remit, part of your responsibility as a regulator to be advising the government through your top management up to the board that because you don't have any authority now to in any way control or act as a checks and balances with the insurance industry, that the board or your chief officer needs to take a paper that you prepare to the board to say that we need to look at how the insurance part of SEMA as a regulator can have some influence. If you don't want to use the word control, that's okay with me. Some influence into having to approve the increases that are coming down the pike. Because it is hard for the consumer to understand that on a $53 million underwriting net position, after laying off it, you only have $5.4 million in claims, which gives you a $48 million profit that you can justify a 20+% increase in premium.
Mr. Chairman, yes, that is possible. Of course, we need to do a little bit of research on how it could impact, and of course, do advising the government is part.
Can you give this committee an undertaking that you will do the research and make the necessary recommendation to your chief officer to do whatever is necessary to give the insurance regulators some influence on premium increases in the industry, in the local market?
Mr. Chairman, I can do research and suggest to the senior management or executives of SEMA and say how best we could intervene to look into this. Whether it is going to by way of hard rule to say, no, you cannot increase more than 10%, or just to say it has to be a rate of this much, is what is not clear to me at the moment. But yes, I can say there is a need that we need to look into the rate aspect or the premium aspect of it and see, identify, for a lot of research needs to go in to say, just to make sure that, okay, who is making these profits and maybe way to go after them as opposed to the companies that are struggling or not making that significant effect. So it cannot be, I don't think, just a rule across affecting everybody, because then there will be companies that are making smaller profits margins could get affected the same way. So yes, that's definitely opportunity for us to do research and suggest something to the executive committee.
There are some of my friends who believe that the premiums charged in property insurance here are really related to what the insurance company believe the market will bear, because they own properties in similar jurisdictions in the Caribbean, which have basically the same exposure to hurricane, etc., on which these premiums are determined. But in one jurisdiction, they're paying substantially less for property insurance than they're paying in this jurisdiction. And we have brought motions to the Legislative Assembly to ask the government to do a study, because you really can't explain to me that there's a significant difference of property insurance in Cayman compared to property insurance on another Caribbean island when the risk is the same. The risk in some of those, in terms of the history of hurricanes, are much more frequent than it is in Cayman. We're running now 13 years since we haven't had one, but yet we are the ones that are getting the horrendous increases year after year after year, and the other jurisdictions where the economy is such that it doesn't support large premiums, right? Their premium is cheaper.
Mr. Chairman, with respect with the statement that you said that the increase of premiums, again, if you look at the numbers, I don't know whether the last few years the rates were actually going up or the rates are going down.
I can tell you, sir, I don't know what they're reporting to you, but I don't have too many people coming to me and saying that their property insurance has gone down in any year since Hurricane Ivan. I can't recall my insurance broker telling me that my insurance premium went down. In fact, if I recall correctly, I believe it's gone up every year since Ivan. And I had no claims on Ivan, personally, right? So I don't know what numbers you are getting that suggests that the insurance on property has gone down over the last couple of years.
Mr. Chairman, of course, we haven't gone into that detail of study to talk to the policyholders and companies to identify, but I'm looking at the top line, the last 7 years.
Is it possible that when you look at premiums collected, right, that some of that is because some of the larger property insurance, like the big condo complex, have moved their insurances offshore post-Ivan and taken it out of the market completely, which is given the false position that premiums are going down?
It's possible. I'm looking at the statistics from 2013 till 2017. So I haven't gone to the 2004 and 6 that years. It's possible. There are larger properties here that they directly secure insurance from overseas carriers that are not licensed by us. So yes, so this doesn't really reflect the total premium that all of us are paying to insurance companies. So that's possible.
You can get out your textbooks because you're going to get a recommendation.
Quick question. Is Cineco regulated by SEMA also?
That's right.
I'm looking, and forgive me, I'm just going by memory. In terms of their the balance sheet that I saw, and for the risk that they're carrying, is Cineco, in terms of does it have the sufficient capital that is required, or that would have been required of a traditional insurance company? You can answer that one because it's a public company, so it's owned by the people.
Mr. Chairman, I'm also governed by or subject to monetary authority law, where it restricts me from discussing specific licensee matters. But if a company has made losses, and if the solvency come down, and if it's on the balance sheet, I think that's public knowledge. But whether, as a SEMA person, whether I could comment on it now, because I'm subject to Monetary Authority law.
Fair enough. Well, I kind of have an idea what the answer is, because as you just pretty much said, it's been taking losses, and there's no major capital injection that's going into it from what I understand the last time when I was looking at their numbers. With that said, and the reason why I'm bringing this up is considering that you guys are also in the, I guess, the regulating these insurance companies. Here's one company that is pretty much being forced to take on risk that the other companies aren't taking on. So on one hand, you have, looking at the 2015 numbers, a group of companies. Would Cineco be included in those insurance numbers?
The numbers of
Yeah.
the annual report, yes.
So so there's a possibility then, if SEMA is losing money, and the net profit of those companies is 51.5 million thereabouts within that division there, and they're making losses, it means then that SEMA's losses is actually pulling those private sector, those other private companies' numbers down. Cineco. So it means that Cineco is losing money. And combined, they're all making 51.5 million profit on health. It's safe to say then that the other companies are making above 51.5 million, and it is the SEMA's losses that are pulling them down to the 51.5 million. In that vein, the question is then, one company, which, again, I'm just going by my memory, not capitalized, which is in essence giving credit to other companies, because we see the problem at the hospital now. I mean, per the Auditor General's report, we have a 94% coverage rate in terms of people who are covered in health insurance. But you have the hospital that have not collected over $100 million in the last number of years. So on top of that now, let's just put it in the bigger picture now. They're collecting premiums from the public, the private sector. The people who they're collecting from, their customers, goes to the HSA. So on top of that, and receive service from the HSA. And then because the HSA don't send the claim within a certain time, I think it's 6 months by law, whatever, 180 days, 6 months, they don't pay them. So then the HSA is losing money, racking up their accounts receivable, and these guys are basically laughing literally all the way to the bank in terms of the money that they're making, and the consumer / taxpayers is left to turn off the lights. And the only entity that has all of these numbers spread across them on one spreadsheet and one database is SEMA. And at some point, when you add up all of those spreadsheets, and you're looking at Cineco over here, struggling, and looking at all of these guys over here making money, at some point, it has got to kick in to say, we need to do something. And what I would like from you, Ron, because I recognize that there's a management committee at SEMA and there's a board. I'm not going to put you on the spot today. You're just here to let us know that the insurance is being managed properly. What I would like from you is to go back, take that spreadsheet, and say to those guys, listen, what Cineco is doing is unsustainable. And what these guys are doing isn't right. And we need to do something about it. But we can't have $50 million plus, could be more. I don't know what SEMA's losses was, Cineco's losses was to pull that number down. But the reality of it is, where the public is concerned, this model is now unsustainable. And what we would very much like to do as legislators, and this is something that I guarantee you that we'll be raising at some point with the Minister of Health and also the Minister of Financial Services and the Minister of Finance that we all need to come together and find a way to stop this bleeding. But what SEMA can't be is an innocent bystander along the way, just compiling the numbers and looking. You guys still have to be looking out for the public. And in this case, the public is cynical. But I really want to thank you because you've been very forthright and you've been very helpful. But like I said, some of this stuff we recognize is beyond you, and this is not to take anything from you because we appreciate what you have done here today. But for us now, our job is not just to look at legislative issues, but also to increase public awareness on certain issues. And what we're hoping to get today from this PSC hearings today is to increase the public awareness in what is going on, not just on the health insurance side, but also on the property insurance side. And to let them know that, no, we are aware of these issues, but also to say to the insurance companies, we are also seeing what you're doing. And if you think you're going to be continuing to get away with it, think again. All right, so Mr. Chairman, that's pretty much it for me on this line of question. I will yield.
My final question would be do you, as the regulator of the insurance industry and being part of SEMA, which regulates the banking industry, do you see any conflicts in the banks themselves selling or providing the avenues for their mortgagees to buy life, property insurance through them from their own companies?
Mr. Chairman, I believe you are referring to a situation where a bank owns a broker or the bank holds a broker license as well, so that when a client walks in to get a mortgage and they say, oh, we have the broker license, work with this insurance company. The broker's role internationally as well as in the Cayman, and our expectation is that brokers cannot work with just one company or two companies. Brokers should provide the customers options. Now, having said that, if I mention, say for example, property, I mentioned there are about 12 companies. A broker may not be able to provide 12 quotes, but they can still provide 4 or 5 quotes. And the customer has a right to demand quotes. And we have told the brokers that they have to. They cannot just have a license just to refer business just to one person or one insurance company. So if it works that way, then there's no conflict, because the broker's role is to advise the client the best option. That includes not only the premium, but of course the terms and conditions and coverage, everything. So if that's not happening, SEMA looks at it.
But that is compounded by the fact that the bank is providing the financing to buy the insurance as well. And oftentimes they simply add the premium for the property insurance and or life on to the amount that is mortgaged. And sometimes there are situations I have seen where, although the person makes every payment on time for the year, the principal does not reduce because the cost, what the bank is charging them for their property insurance and or life insurance haven't been added on to the principal has actually increased. Now there has to be something wrong with that situation. What intervention or what are the consequences if you find a situation where a bank has not given 3 quotes, but they've simply said to the customer, look, we will finance the insurance and we will provide you with the insurance, and they simply buy it from the company of their choice, right, and add it on to the mortgage principal?
Mr. Chairman, customer should be told upfront that, okay, you came here to get the mortgage, here's the mortgage. However, you need insurance to cover your mortgage, life insurance plus property. if you want a one-stop solution, we are working with company A can provide this. However, if you have a better quote or a better relationship with a different company, we are ready to accept it. That should be the right way of doing it. Personally, I have a financing arrangement with a bank for a motor vehicle, and they gave me the options, and I chose to go with them. That's my personal choice. But they are required to give you a choice. They cannot bind someone just because they give you mortgage towards insurance. They should give options.
Here's another concern I have that maybe falls within your bailiwick. Some of the banks will provide you with a life insurance on one or two ways. You pay a monthly premium as part of your mortgage payment, and they will give you life insurance to the value of the mortgage. The two options are, you can pay this amount and your life insurance will stay at the top value, and if something happens to you, they pay off the mortgage and your estate will get the difference. Or you can reduce it annually to whatever the mortgage balance is, and if something happens to you, well, you got dead to get life insurance, so you're dead. It pays off, it liquidates the mortgage. Now, at the end of that mortgage payment or period, if I apply to that same life insurance company for a life insurance at that premium, because that's the premium they were charging me, right? Should the insurance have to honor that premium for me, and I can keep it at that value?
Mr. Chairman, for me to better understand the questions, for example...
Okay, let's see if I can give you a scenario. Let's suppose I had a $250,000 mortgage. So I started off and said, okay, I want to keep my life insurance at $250,000. So my mortgage is 10 years. So I paid a life insurance premium for 10 years to keep it at $250,000. When I've finished paying off the mortgage, I should be able to go to the insurance company and says, I want $250,000 life insurance and I want it for this premium. Can they refuse it?
Mr. Chairman, I'm afraid it doesn't work like that, unfortunately, because life insurance, the premium depends on your age of entry. So if you buy a policy at the age of 40 for 10 years, you are rated for your age at 40. You know, it all depends on the mortality probability. The probability of you dying by a natural cause at the age of 40 is less than an 80-year-old, for example, mathematically. So they give you the mortgage cover today at a rate, assuming that you would survive for the term of the mortgage. And you survive for 10, 15 years, and if you want to now buy an insurance cover for the same sum assured, then you are rated at that point because your age has different. Or the other option is that if you wish to continue for longer period, you buy, say your mortgage is 15 years, but you buy for 25 years and say, well, I'm covered that 15 years, something happens to me.
They don't give you the option to go beyond the life of the mortgage?
Well, I'm not sure. Again, I haven't gone through personally, but if you have your own insurance, I don't know whether you can attach that to the mortgage. So because then you can assign the policy to the bank, so the bank has the financial interest over the policy. If something were to happen with that mortgage period, then you continue that. But the second option, I think you mentioned, so the second scenario you mentioned, it's called the mortgage reduction. So if that is the policy that you have taken, then your sum assured reduces with your outstanding balance. And so at the end of the term, you have like zero balance to pay, zero coverage. So it cannot technically continue.
If not, so thank you very much. And like I said, you can take out your textbooks because the recommendation to investigate what we asked you about will be coming. Thank you very much.
Thank you, Mr. Chairman.
Brings us to the end of business for the day. So we will adjourn until tomorrow is 9 o'clock or 10 o'clock? 10 o'clock tomorrow morning.